Hello, guys. Today I am meeting you in the third chapter. So, today we are going to discuss the accounting principles and concepts. Okay, accounting principles and concepts. Okay, in accounting principles and concepts, there are eight concepts there. One is going concern. Second one is accrual basis, and materiality. Third one. Fourth one is consistency. Fifth one is prudence. And sixth one is duality. And seventh one is business entity. Eighth one is historical. Okay. So first of all, we can see what is going concern. Going concern. The financial statements are prepared on the assumption that the reporting entity is going concern and will continue in operation for the foreseeable future. That means we are preparing the financial statement on the assumption that our business will continue for the foreseeable future. I mean, indefinitely. Okay. No, most of the people start the business indefinitely because they don't have the time period. Okay, no, some instances, not the companies, joint ventures or some consignment activities are for those type of business. Sometimes they used to start for the limited period of time. After that, the business will cease. But normally, anybody who is starting the business, they hope to continue the business until they survive, until they live. Okay, so that is the meaning. The financial statements are prepared on the assumption that the reporting entity is going concern and will continue in operation for the foreseeable future. That means foreseeable future in the sense indefinite period of time. Okay, there is no stipulated time period until this period only I am going to start or I am going to do the business or something like that. No, no. Okay, possible future. That is a going concern concept. Second one is accrual basis. Uh, accrual basis. Regardless of cash movements. Okay, regardless of cash movements, transactions and other events must be recorded in the accounting records within the financial period such transactions or events take place. Within the financial period, such transactions or events take place and shown in the financial statement. Okay, the brief meaning of this is the regardless of cash payment means some people used to do the accounts on the cash basis. Okay, that is not actually right. That won't show the real uh, situation of the economic situation of the company. Normally, people the people will do the business on the basis of cash and the credit. Okay. Uh, Normally, the businesses you used to give a credit period of 30 days. Okay, 30 days. They might give 30 days credit, 30 days credit, or some people give 60 days credit. Some businesses give 90 days credit. Okay, this is the credit period. Okay, within which the people, the persons who purchase the goods or services from that particular entity has to settle the credit. That means if it is within the period of 30 days, they have to settle within that stipulated 30 days. If it is 60 days, they have to settle it within that period. If it is a 30 days, 90 days, they have to settle within 90 days. Right? The For an example, you will say uh, within 30 days, the entity grant a credit period of 30 days. 30 days. Okay? Days. One transaction. And other is cash. Cash. Transaction. So both transaction has to be recorded in the set of books. Okay? Uh, Invoicing date. Right? The transaction has to be recorded on the invoicing date. Invoicing, invoicing date. Right? This has to be recorded. This has to be recorded. If it is a cash sales, invoicing date. If you say today is the 1st of January, then 1st of January the credit sale has to be recorded under credit sale. Cash sale has to be recorded under cash sale. Both has to be accounted and presented as a sales during that period. During that period. That's what they say, regardless of cash movement, transactions and other events must be recorded in the accounting period within which such transactions or events take place, and such and shown in the financial statement in the relevant period. You see, so that is the correct uh, explanation for the accrual basis. Like that, income also, expenses also has to be recorded like that. If you say uh, telephone expenses, phone expenses, phone expenses this month is this much, previous month is this much. Okay, previous month, if you didn't settle the previous month bill, that means you don't need to show. No, that is wrong. Even though you have paid or not, the expenses related to such period has to be taken into the account, right? That also has to be taken. Expenses and income, whatever it is, has to be taken into the account apart from whether it has been paid or not. Okay, that is the meaning of accrual basis. Third one, next we can say the materiality. This states that the information that is likely to influence users' decision must be disclosed separately. Right? Materiality may differ from one entity to another entity. Okay, materiality may differ from one entity to different entity. I mean, A is the one organization, B is the one organization. Okay, so here turnover is, for an example, I'm saying turnover is 10,000 rupees. Okay, here for B, the turnover is 10 million. Okay, for A, 10,000 rupees turnover. For me, B, 1 million. So you can say there is a loss or some flood took place or something like that. For flood or some other reason, 1,000 worth of 1,000 rupees worth of goods were destroyed. Right? 1,000 of worth of goods were destroyed. So whereas in the books of B, entity B, 1,000 for them, when 1,000 when they compare with when they compare with the 10 million, it is not a material one. It is a simple one. It is not a big amount for them. So they don't need to disclose this 1,000 rupees here in the set of accounts. But in the profit and loss account, separately, they don't need to um, disclose this 1,000 rupees loss due to some other reason, the loss of goods, 1,000 worth of goods due to some reason. They don't need to disclose it separately. They can disclose that under the. They can show it under the head accounts. Right? They will show, but they don't need to disclose it separately. But whereas in entity A, the 1,000 is when you compare this 1,000 with the turnover 10,000, it is a very big amount, material amount. So they have to disclose this particular loss separately. Okay, can you see the difference? For B, this 10,000 is not a material amount, big amount. For A, it is a big amount. Like that, materiality will be judged. Okay. So that is the meaning of materiality. This states that information that is likely to influence a user's decision must be disclosed separately. Okay. Here in the entity A, if any users going to make a decision, this 1,000 will influence them. Whereas in entity B, this 1,000 not going to influence them. Okay. When they are making a decision. That is one materiality concept. Next, we will come to the consistency. Consistency. The same methods and policies must be applied on items preparation of financial statements during and subsequent financial periods. This is to ensure that the information is comparable. Right? If there are any changes take place on methods and policies applied, it has to be disclosed in the financial statements. So consistency. The same methods and policies must be applied on items and preparation of financial statements during and subsequent financial periods. Okay, for this consistency. Consistency in the sense, if you have started preparing the financial accounts on the cash basis for this year, in the sense you are not going to concentrate in the credit sales. Okay, credit accrued incomes. Okay, so in such case, you have to continuously prepare your accounts on cash basis. 1 year you are preparing on cash basis, and second year if you are preparing on accrual basis, then problem. It is not acceptable because year one, year one, year one, year two, year three. Okay. If you are preparing it on cash basis, year one you are preparing on cash basis, and year two you are preparing on accrual basis. Can you compare these two accounts? There will be a drastic difference between year one and year two when you compare the income or expenses or anything, right? Because cash basis it will show a lesser amount. Accrual basis will show a greater amount because you are including the credit sales in accrual basis. That is what consistency. And other example I can show it. I can tell you. This is where you can understand very quickly. That's what I took this example to elaborate. Another example, if you purchase a machinery, okay, machinery, you have to depreciate. Okay, you have to, machinery has to be depreciated. No, it has a lifetime. Okay, humans have the lifetime. Okay, lifespan. Mostly in Sri Lankans have a lifespan of 70 or 60 years. Okay, after that, there are chances to go away from this world. Like that, machineries also depends on their usage. They have, the company will determine the lifespan or usable time. So if it is the, if you say this particular machinery lifespan is 5 years, okay, company determine that this particular machine can be used in the production for 5 years. After that, there is no use. Okay, so the machinery's cost has to be distributed among all this five, all 5 years equally. Then only the correct profit and loss can be shown in the account. Okay, so when you're doing the depreciation for first year, there are so many methods of doing the depreciation. One is straight line method. Straight line method means later on we can see the methods of depreciation. One is a straight line method. Okay, second one is diminishing method, like that. So many methods are there. So while first year you are depreciating the machinery on straight line, okay, and second year if you are depreciating on diminishing method, means that also will affect the comparability of the financial statements. So that is not allowed. If you are adopting the method of straight line method for the depreciation, you have to continuously all for 5 years you have to use this depreciation on straight line method. If you are adopting diminishing method, you have to adopt that method all those 5 years. You cannot change it. Okay, if you want to change, you can change, but the change has to be disclosed separately in the financial statements as a note. Okay, special note. So we have seen consistency, and fifth one, prudence. Prudence concept. The exercise of caution when making judgments under conditions. Okay, conditions of an uncertainty. For example, the exercise of caution. When you exercise some judgments, we must be careful, and the exercise of caution when making a judgment under condition of uncertainty, under the condition of uncertainty, right? The exercise of prudence means that assets and income are not overstated and liabilities and expenses are not understated. Okay, the exercise of caution when making, okay, making judgments under conditions of uncertainty. The exercise of prudence means that assets and income are of are not overstated and liability and expenses are not understated. For this, very good example is debtors. Okay, debtors. Debtors. Who are the debtors? Debtors means for the people to whom we have sold our goods on credit. I told you, we used to sell the goods on credit basis and cash basis. This is 30 days credit basis, so 60 days credit basis, like that. So these people are called as debtors because they owe money to us. Okay, they owe to us. Okay, so these people are shown as a current debtors are shown under the current assets in financial statements, balance sheet. Okay, so if we see one of the debtor is uncertain of paying back the money, when he bankrupt in the sense he lost everything, and we cannot, even we file the case in the courts, we cannot recover the debt from him because he has zero money and he doesn't have any assets, anything. So there is an uncertainty of recovering money from him, right? So we have to make an arrangement in the financial statement. We have to write off that amount from the debtors. So we have to write off it by bad debtors. Uh, Debtors. Because they are bad debtors, no? Bad debtors. If he is not paying, he's a bad. So bad debtors we say. Bad debtors. So here only the prudence concept says the exercise of caution when making judgments under conditions of uncertainty. Okay, judgments under uncertainty. If we write off that for one, if we say 1 million, 1 million from the accounts, okay, then this will reduce our income, expenses, right? Reduce our income, understating the income. Yes, income are not overstated. This will understate the our income and understate our assets also. Okay, so this is what say the when you are exercising the caution when making judgments under conditions of uncertainty. If it is if he become a bad, then 1 million loss is taking place. Okay, we are reducing our income for the purpose of some people used to write off the debtors to show the income under to understate the income. Okay, to overstate the expenses. Okay, so this when you are making the judgment whether that particular debtor is bad or not, you have to exercise a caution because if he's become a later on if we say no he we can recover it, then that is big problem. So that is why the student's concept says. Students, the exercise of caution when making judgments under conditions of uncertainty. The exercise of prudence. Next one is duality, dual aspects, dual aspect, right? In the dual aspect, each and every transaction has two effects. Okay, when we are talking about debtor and creditors, debit and credit, double entry, we can understand that very clearly. Every transaction has a two effect. That means one is for debtor, debit, another one is credit, we would say. And it will affect two accounts also. Okay, debit to the one account, and credit to the another account, another account. Okay, so there can't be a single entry for a one transaction. There is a double entry. That's what this says. Duality refers to the fact that every transaction has a dual aspect and therefore requires the use of double entry accounting. It has a dual aspect and therefore it requires the use of double entry accounting. Duality refers to the fact that every transaction has a dual aspect and therefore it requires the use of double entry account. There should be a double entry. There can't be a single entry for a transaction. That is it is explained by the duality. And seventh one is business entity. The business entity principle simply means that for the purpose of maintaining accounting records, the business is treated as a separate entity from its owner, right? From its entity, from the owner of the entity. Okay, the business entity principle simply means that for the purpose of maintaining accounting records, the business is treated as a separate entity from its owner. From its owner is very suitable. Okay, from its, its owner. Because the business is separate and owners is separate, right? If I am starting a business, right? No, I will say A B. I am A starts a business on the name of ABC. ABC. Okay, he starts a business as a ABC. The entity's name is ABC, but owner's name is A, Mr. A. Right? Phone bill. We will say rent. Rent. Rent for the ABC Limited is 50,000. Right? Ace rent for the Ace personal house is 10,000. Okay. So A cannot show his own house rent under the ABC Limited. He can show only the ABC Limited's rent under the ABC entities accounts. He cannot show his house rent under this entity. That is what the business entity concept says. The business entity principle simply means that for the purpose of maintaining accounting records, the business is treated as a separate entity from its owner. Okay, from its owner. This is the clear cut explanation for you because I am separate person from my business. Okay, I cannot put my expenses or I cannot show my personal expenses under the under my company's accounts. Next principle, eight is historical cost. Historical cost. Historical cost measures assets and liabilities at the value at which they were initially recorded, and that value will be based on the value at the date of the transaction. Okay, this historical cost measures assets and liabilities at the value at which they were initially recorded, and that value will be based on value at the date of the transaction. That means historical cost in the sense assets and liabilities. Okay, for example, furniture. If you furniture and fittings, right? Furniture and fittings. The company purchases on 2023. Okay, at the cost of 50,000. Okay, 50,000. Furniture and fittings, the company purchase at the 50,000. And in 2024, it has to, the cost of the furniture will be 50,000. Purchase price is 50,000. Right? This was the invoice value. Okay, invoice value. Hmm. Invoice value as at that date. Okay, so this will be when you're valuing the furniture and fittings, that has to be the value appearing in the books as at 2023 December is the 50,000, then that has to be brought in. Okay. Otherwise, story of measures assets and liabilities at the value at which they were initially recorded. This was the initial record amount. This is the initially recorded amount. Okay, and that value will be based on the value at that at the date of the transaction. At the date of the transaction is this. I mean, this is the 10th May 2023. Okay. Invoice value was 50,000. You had to go for the value which is appearing in the last financial year. You have to take it off. That last financial amount should have been derived from the transaction value. Transaction value was the same. It should be the same. There won't be any difference. Right? That's what they say when you are valuing the amount, valuing the assets and liabilities, it should be on historical cost. That's what they say historical. Historical cost terms in the past value, historical. What is the value appeared at the date of purchasing? Okay, purchase value. This was the purchase value. You can say value. Okay, purchase value. Okay, purchase value. Historical cost measures assets and liabilities at the value at which they were initially recorded. This was initial record. This is called initially recorded. Hmm, recorded amount. Maybe. Right? This is this is meeting the all the conditions, right? Historical cost measures assets and liabilities at the value at which they were initially recorded. That is the condition number one. Initially recorded. This is the condition number one. Okay, initially recorded 50,000. That is recorded here. And that value will be based on the value at the date of the transaction. At the date of the transaction. Okay. At the date of the transaction. This is the date of the transaction. That is the same value. Initially recorded. This is the initially recorded. Condition number one and condition number two. Both met here. This is the final. This is the one we are recording. Okay. This is the historical cost. Okay. And next, and now we are concluding the subject chapter with this, and I will meet you in chapter 4. Thank you for watching, and I hope you would have understood all the explanations what I did here in this subject. And please don't forget to subscribe my channel.